Hi, this is Zach here with the Bulletin Board Heroes here at Zach's Traders Cafe for Monday, the 27th of March. Starting off with the FTSE 100, where we're trading either side of the 200-day moving average there at around 74.20. Ideally, we close above that and give ourselves a bit of confidence that the low is in place, i.e. the low of last Monday towards 72.06. In fact, that was the low. That support line projection there could be a target if we break down below the October uptrend line. That's at 73.50 or so. But at the moment, giving it the benefit of the doubt, even though the RSI in the higher 30s is in the wrong place for a rebound. If you're really fussy, to wait for a 7600 plus to end the recent bear phase that we've had. Otherwise, an end of day close below 73.50 suggests that we might get down to 7200 or so again. But been in the middle, and obviously by definition being near the 200-day moving averages, right on the boundary between bullish and bearish. On to the DAX, which has been in a better place than the FTSE for most of this month. So the market never going anywhere near the 200-day moving average, which is way below where we are at the moment, more than 1,000 points. We bounced off the October uptrend line on Friday, which was good, and we're just really waiting for an end-of-day close above the 50-day moving average at 15,300. If we can achieve that over the course of the first part of this week, then we could be back on course for a rather unlikely move towards 16,200 in the top of that October rising trend channel. Only back below 14,800 risks the need for another test of 14,500, which was not only this month's low zone, but also November, December resistance. Eagle-eyed traders will be looking for the RSI currently just below 50 to break above that neutral 50 level, which would be quite a coup and quite a decent signal. We've also got the 50 and 200-day moving average is still rising here just. So that shows that there's almost quite a contrast between this market and the FTSE 100. Obviously not quite as good on the Dow either. That's probably more a FTSE 100 type situation. So we're trading either side of the 200-day moving average at 32,300. We bounced off that uptrend line from October, which is a decent thing or a good thing. That's around 31,800. We're waiting for an end-of-day close for the RSI back above neutral 50 versus the low 40s. Probably end-of-day close for the RSI above 50 and above the 200-day moving average would then give us the confidence that this market can head back towards the 50-day moving average at 33,200. On to Bitcoin, where we're still chomping at the bit for this market to get back above 30,000. Here, rather quiet day so far, but we've made good progress within this bull flag, based around 26,700 and the top of that at 29,000. Probably the easiest thing here is to wait for an end-of-day close outside those parameters. If we break down, then it would be back towards 25,000 and the 50-day moving average just below it. Or if we break higher, then the big resistance here, 32,000, which is the top of that broadening triangle from June, and also June resistance from last year. But only through 32,000 really ends the pain that we've had since June with the breakdown for this market. On to the stocks, and the first is AIQ, and here you can see there's just the beginnings of a turnaround. We've had a gap higher, really strong hammer candle on Friday, bullish divergence as well. So that suggests that there's enough gas in the tank here to retest the February resistance zone around 12 pence. Might have been able to get up to 14 pence over the next 1 to 2 months. But the bullish divergence and the bear trap gap reversal really the kickers there for AIQ. Onto a stock which was something of a hero a year or two, well, a year back at least, in the early part of 2022. Maybe back now with the rebound off the falling support line there from June 2021. That was around the 3.5 pence level, and above 3.5 pence level, above that level, we're looking for this market to return towards 5 pence, which is the area of the 50 and 200-day moving averages. Hopefully the stock can snap that dead cross, which obviously didn't look very good a couple of weeks ago. Through 5 pence, they're looking for 6 pence at the top of that broadening triangle from back in June. So the ideal thing here is that we stay above 3.5, we close above the old November support area around 3.9 pence on a weekly close basis, then 5p and 6p. On to Inspec, which has been in Inspecs rather, which has been in decent recovery mode since the start of the year. We've now seen a few closes or at or above the sharply rising 50-day moving average. We had a very strong hammer candle to turn this around. That looks like the floor of that rising trend channel from November, and especially while we're above the 50-day line at 95 pence, looking for not only a retest of February resistance around 120, but then up to 150. Maybe as soon as the end of next month. So let's see if the shares can come up with a good stop loss here. Really below 90 is the ideal situation there. On to Kefi, which I think I covered last week, and somebody's asked for it today. We were looking for a break of the 0.8 area to lead to a penny, and that's exactly what we got today. In fact, almost one pence on the nose. The current position is that we're hoping that we'll have support coming in at or above the 0.9 pence area, and then the shares will then build to a new higher level. We've spent long enough, I think, consolidating on this stock. Next target up as high as 1.3 pence, which is a July resistance line projection from last year, if we can get a decent weekly close above a penny. But the ideal situation is here we stay above the 0.9 pence level. On to Kistos, which I suppose was, again, yet another hero from the early part of last year. Very disappointing that the shares came back as much as they did from 650 plus, but that's life. Here we've got the bounce off a falling support line in the RSI window, quadruple bounce, in fact, and we've broken that line of resistance there from January. That was around the 295 pence level, let's call it. And above 295, looking for the shares to hit the top of that broadening triangle from February, as high as £3.50 by the end of next month. So let's see if the shares can build above the £3 area to get to 350 over the near term. One of the most consistent plays of the recent past has been Premier African, and here we achieved our previous target around 0.83. Above 0.83, we're looking for as high as a penny over the next 2 to 4 weeks. Multiple bounces off RSI 50 over the near term, basically for almost the whole year, in fact, so the whole year to date. So that suggests that a penny should be on its way well before the end of next month. Delays for San Leon, but the shares seem to be shaking that off at the moment, so up 4% today. Here it looks as though we've had the final bear trap below the 20 pence level. Gap closed buy signal on the 21st, which is last week, and we built quite strongly since then. Gap to fill up towards 28 pence, and that may be done over the next couple of weeks. And then the big picture target, maybe by the end of next month, to head up to 36 pence at the top of that broadening triangle from back in August. This stage only well below 21 pence, and the old February support really delaying the upside or the recovery argument. Onto a stock which I don't look at very often, but looks quite encouraging. Here we've got Tharissa. The traction here is that we've had a bear trap gap reversal, so from below the December support there around 92 pence. Above that we're looking for 110 or 112 pence by the end of next month, especially with the very strong candle that we've had today opening at the low above Friday's resistance. Just a few stocks to go now. First one is Technology Minerals, which is had a sugar daddy coming in and financing the company, which is obviously very kind. Here we've got bullish divergence there, but uptrend line there from back in October, and the first signs that we've got a recovery from with that bounce off that line. Ideally, we head up towards at least the 50-day moving average at 1.2 pence, even if the shares then drift after that. The 50-day line's really been the resistance zone for the shares since the start of the autumn. Next situation is Verditek, where the company's had quite a few attacks from the bears, but here shares doing well with this. We had an unfilled gap to the upside over the last week or so, rising 50-day moving average. So expect that this is a mid-move consolidation ahead of a move up to 1.2 or 1.3 pence over the next couple of weeks. 1.3 pence, the 200-day moving average. I've covered ValiRx quite a lot of late, possibly more than I should have, but here we've got an uptrend line in the RSI window, and we're just breaking the 50-day moving average at 10.25 pence. A great candle on Friday with the open on the low and the open, and the high and the close. And we're expecting with an end-of-day close above the 50-day line to head up to 13 pence over the next couple of weeks. RSI is also pushed out through the neutral 50 level, so that is a positive as well, and it's an overall bear trap from below the 9.25 pence February support. Finishing off with the, well, at the moment it's the top riser of the day, which I actually covered the shares yesterday, so I'm feeling pretty pleased about that. Here we've got a situation where the multiple bounces and the bullish divergence line kicked in very nicely. That's why I talk about and use the bullish divergence phenomenon above the 50-day moving average at 8.5 pence or 8.6 pence. We're looking for 14 or 15 pence over the next couple of weeks, and maybe even more given the bullishness of that RSI configuration. That's it from me today. More updates tomorrow.